Hey everybody, welcome back to the show. Another live Q&A. It seems like forever since we've done this. Has it been a couple of years? I don't know. As always, give me a thumbs up if everything's working. If you're new, this is your first live Q&A, and you want to ask a question, just type in the chat at the @ Rob Berger. Just helps me see the chat and skip over all the banter, although the banter is probably the best part of the show. I got to tell you, I'm really stoked tonight for two reasons, and they're related. And no, it's not whether the Fed is going to cut rates or the impact, although we'll talk about that. One, Manningcast is on tonight. And two, and this is just as important, Bill Belichick isn't part of the show. He was terrible. I don't know why they had him on the show last year. I don't know. When I heard he was taking a coaching job, in a college football team, I was thrilled. Anyway, I see the thumbs up. We're good. Okay, we're live. Great. So I thought I would just talk a bit about the Fed rate cut, if they're going to cut. I'm not really predicting whether they'll cut or not. I mean, all the pundits say they will. It's not clear to me that they should, actually. I mean, they have sort of a dual mandate, right? They want to keep prices in check, right? They want to keep inflation under control. That's one thing. And they also want to keep us at full employment, but without overheating the economy, right? And then that triggers inflation. And so there's this sort of back and forth and balance between employment and prices. And at least if you look at inflation, I don't see any reason why they should cut. I mean, it's certainly obviously moderated from where it was a couple of years ago, but it's still above their target. I know they've sort of softened their stance on the target, but still it's above the target. And there's some indications it might be creeping up a little. We're not sure. We're kind of waiting for the tariffs effect. Is that going to affect it or not? But then the concern is that employment is kind of soft. I mean, we haven't seen a big change in the unemployment rate, but the number of jobs being added has got everyone concerned. And so there's apparently some softness in the job market. And so, it's like, well, okay, if we lower rates to try to, what it would do in theory is encourage investment. We can think about it like a mortgage, right? I mean, people are more willing to buy a house when you've got really low interest rates as compared to when you have really high interest rates. Well, businesses are the same way. Of course, we may be looking at a 1/4 point cut, maybe a 1/2 point cut, I suppose, is possible. Those in and of themselves aren't huge, but then there's this question of, will we get a couple more cuts this year? What about early next year? And it could have this effect. And it could get companies investing again, which could grow employment. So, and then the question is, well, what does that do to inflation? And then you add the tariffs in, and I mean, the economists don't agree. So, and they know a lot more about this than I do. So, you see all these sort of competing pressure, if you will, on the economy and what the Fed cares about. There's a couple of things coming out this week that I'll just show you real quick. Apparently tomorrow, the BLS is going to release revisions to some past numbers, and at least some think the revisions could be very, very significant. So apparently the Fed will be watching that. And then the release here for the Consumer Price Index is coming in September 11th, which is what, Thursday, I think. So that's going to be a big number, and the Fed and everyone else will no doubt be watching that. One of the things that if you've watched this show long enough, you know that I've not changed anything about my investments, and I won't. I'm not going to change my bond investments or anything like that. And largely the reason is, well, there's a couple of reasons, but for our purposes, one of the big reasons is trying to predict interest rates and inflation is incredibly difficult. And I have no confidence in my ability to do it, or to then predict how that's going to affect the bond market or the stock market. And I've in the past I've sort of gone through my mind what I think's going to happen, and it's just amazing how wrong I am. I mean, it's like I'm not even close. I'll get it right in the sense that I think inflation will come in a little higher or lower. The Fed will do this or that. But then the bond market doesn't react the way I thought it would. So I might get the underlying economic direction correct, but then I get completely wrong how the market reacts to that. And so, but so then you say, well, okay, Rob, appreciate that. Okay, that's good. But why are we talking about it then? We're talking about it for two reasons. Well, three. One, it's interesting, and there's a lot going on right now. At least I find it interesting. But two, I've gotten a lot of emails from folks. Some folks are actually already worried about the bond market in 2026. And I'm thinking, don't we have enough going on for the next 4 months? And is it 4? Yeah. In 2025, can we just worry about 26, when it gets here? But apparently there's folks out there saying the bond market's going to collapse in 2026. So a lot of people, are concerned about it. But the third reason is that I think it's really useful if you're worried about all of this, and that's really the folks I'm talking to tonight in this short little monologue before I get to the important stuff, your questions. I would suggest that you actually write down what you're afraid of, what the fear is. You're afraid what's going to happen and when. That something's going to happen in the bond market, that inflation's going to spike, and then this is going to happen. Because what I've found, at least, of course, you'll do all this and you'll nail it. It'll be exactly right. But at least in my experience, I'm never right. It's just never, or something comes up that I wasn't even expecting that intervenes, and it may cause some bad things. It may cause some good things. But, I had in my mind, this is what's going to happen. And it was kind of headed that way. And then we got this, out of left field, something came up and it just changed everything. I've done that enough now to know this is just really impossible to predict. And trying to constantly change your portfolio to try to figure out what you think is going to happen, I just think I think it's not a recipe for long-term success. Now, I will say one thing, and I saw this question in the chat. Let me see if I can pull it up. Maybe not. But one thing that I do believe, if the Fed cuts rates, you will see, I would think, short-term debt, think money market funds, T-bills, high-yield savings accounts, CDs, those rates tick down. Because when we're talking about the Fed rate, we're talking about an overnight rate. It's very short-term. And it can affect longer-term bonds, but boy, there's so much that goes into how the market views the value of a 30-year bond, let's say. And I think it goes much further out than what the Fed is setting their overnight rate at. But for short term, yeah, I think it could affect it, and so we'll see. And I might have some videos on that. But at the end of the day, what's a reasonable investment today? Think your favorite money market fund at Vanguard or Fidelity or wherever you have your accounts. It's or T-bills, if that's what you prefer. They're still going to probably be the right answer for cash, because it's going to affect pretty much all cash investments. It may not be basis point by basis point, but it's probably going to affect most of them. Now, again, other things can affect it as well, but that is one thing to look out for. And by the way, who knows? Maybe my prediction will be wrong on that, but I think that's a little easier to expect when the Fed, say, cuts rates or raises rates. Of course, the interest you pay on like a credit card should go down, if assuming they cut rates. But long term, I think it's really, there's too many factors, there's too many variables, there's too many unknowns. And I think what the Fed does later in the month, could have some kind of effect on those longer term debt, maybe, but it's going to be lost in the noise of all of the other things that affect it. So again, if you're worried about it, write it down. Write what you're worried about. Be as specific as you can, and then check back on that, in a couple of months or the end of the year. I do it in a little note-taking app that I use, and I can actually tag the date so that when that date comes around, it pulls that note back up. I'll show you what I use for that. There's a lot of apps that can do it, but what I use is this app right here, Tana, T-A-N-A. There's a learning curve too, but I really like it. It's a fun app. In fact, if you watch the 5 Question Friday show, and I've used different apps for that show, but more recently what I've been showing you is the Tana app. Here, I'll show you. Let me pull it back up if I can. Yeah, here is so here are the questions that I'm going to answer this Friday. I had to record this video today because I won't be here to record it later in the week. And this is Tana. So, and if I wanted to be reminded about this, next week, well, I could go to 2026 if I wanted to, and I could put in a date specific, right? I could add a month. January, I could add a day. Anyway, you get the idea. And then when that day comes up, that note pops back up. Let me actually delete that date because I don't want it. Okay. That's my rant about the Fed, and it's fascinating. It's important. It's important to the economy. I don't know. I'm curious. I'll ask a poll here. I just don't change anything about my investments, but maybe you guys do. Here we go. Do you, maybe I can ask it differently. Have you changed investments because of, I'll say, expected Fed rate cut? I don't think I'm going to say no. I don't think most of you have. But did I misspell? Oh, here we go. All right. I'll just put yes and no. It's a simple poll. All right. Your questions. Let's see what we've got. So this person wants to know about the GATT rate, to which I would say, I have no idea what that is. I don't have a pension. Apparently it's related to a pension. Huh, it's a thing. It's 487 right now. I don't know what it is, though. Primarily refers to an interest rate derived from the 30-year U.S. Treasury bond rate used in the United States to calculate the present value of a defined benefit pension. Huh. Never heard of that. That's kind of interesting. Again, I mean, one way to possibly answer that, Frank, is to look at the history of that rate and how it moved in response, if at all, in response to Fed rate cuts. Now, I don't have an answer for that because I just learned what it was or what it is. So, does the GATT rate change in response to the Fed raising or lowering its overnight rate? So now I'm asking ChatGPT. They say no. It doesn't directly change when the no. I don't want. Did I see? Now it didn't understand my question, and I think I've worded it correctly. Let me try it again. No. Do changes in the Fed rate affect the GATT rate? Maybe hopefully that's clear. Got it. Thanks for clarifying. Well, you're welcome. The Fed rate is short-term rates. No direct link. The Fed, of course, we know the Fed doesn't set the rate. Yes, indirect influence. Fed rate moves ripple through the yield curve. By the way, what does that mean? Ripple through the yield curve. So imagine we plotted the yield of a 1-month T-bill, and then we did a 2-year Treasury, and then a 10-year Treasury, and then a 30-year Treasury, and that's the yield curve, right? That's what they're talking about. And in a normal environment, it goes up. So the longer the duration, the higher the yield. Sometimes the yield can invert, and you could have shorter date yields higher than longer term yields. But anyway, and since the GATT rate is based on Treasury yields, it can be affected, but not in a one-to-one or immediate way. So there you go. I don't know if ChatGPT is right, but this is a full service show. I do what I can to answer questions that I know nothing about. Okay. But at least I admit I don't know it, right? I don't try to fake it. So John wants to know, when deciding when to take Social Security when one spouse is still working, making enough for a 24% marginal bracket, how do you consider the tax implications? So I take it it's the spouse that's not working that's going to possibly claim Social Security. I have not thought through that question. In part because, well, one, my wife and I don't face that question, and two, at least for me, I'm going to wait until I'm 70. But I mean, at some point, you know, what's the most you can be taxed on? What is 85% of your Social Security? I think that's right. And if you're in the 24% bracket, I would assume you're hitting that. Let's ask ChatGPT. I'm in the 24% tax bracket. How much of my Social Security will be taxed? See, you don't need me. I'll just be a show. I'll just ask ChatGPT. It gives you a bunch of answers. There's thresholds. So above 44,000, 85% taxable. So I got that right. Well, assuming ChatGPT is correct. Well, we know that no matter what happens, it's not going to be more than 85%. It doesn't automatically determine how much Social Security. Instead, it depends on your provisional income. If you're above the threshold, up to 85% of your benefits. That doesn't really answer your question, though. I would figure out how. I don't know that it would change it a lot. I think I would personally probably be driven more by questions of, does it make the most sense for me to start claiming now or not? And while taxes could be part of that, I'm not so sure, at least in my case, every circumstance is different. I don't think that would be my primary driving concern. So for example, in my case, I want to wait until I'm 70 because if I should die first, my wife, who would have a smaller benefit amount, would then get my higher benefit. And I want her to have that, you know, if that happens. Of course, if I don't pass away first and she does, then I'm left with my benefit, right? So either way, whoever survives is going to get my benefit. And that's driving my decision almost completely. So maybe the bigger question is, how much should taxes affect your decision? And I'd have to think through that. I don't have an answer to that. It's just, in large part because it's just not my driving. It's not what I'm factoring. So this is, I think I'm 0 for 2 tonight. Okay. 0 for 2. Does it feel hot to you guys? I'm burning up. Okay. Well, God help us, Kyle, if I'm ever the Fed chair. I haven't gotten a call from President Trump, so I'm assuming at this point I'm not in the running. I don't think I would have cut rates by now, though. Not with the current inflation rate, and unemployment has still been manageable. You know, again, we've seen softness, particularly in the last numbers, job creation numbers. We'll see what tomorrow shows in terms of revisions. So I personally would not have cut yet. No. But again, I was an English major, so what do I know? All right. So 12% of you have already changed your investments in light of an expected Fed rate cut. Okay, so I have to ask another question. I'm going to end that poll. For those who changed investments, by the way, people that come into join the show, like when I first published this, I have no idea what I'm talking about. For those who changed investments, did you buy more stocks? Because some would think, well, rates are going down, and so that could encourage the stock market. Buy more bonds, sell bonds to cash, and I'll just add sell stocks to cash. I realize those aren't the only options, but I only get four answers that I can put up there. Okay. So Dell has a couple of questions. One about SGOV and VBIL. These are T-bill funds. I've invested in both in the past. I don't think I have anything in either at the moment. How will they react to the future markets? I guess by that you mean if the Fed cuts rates. I mean, I would. My best guess would be you'd see a softening in the yields, but you know that can get tricky because other things can happen. Part of it depends on why the Fed is cutting rates, right? So the current thinking is they're cutting rates because employment's getting soft and companies aren't adding as many jobs as they had been in the past, and as the Fed thinks they should. But if the market gets spooked, what do they often do? They go to treasuries. They buy treasuries. Now, not always. We had this issue earlier in the year where that didn't happen. So that's where, again, the market can fool you. So, you know, but if if we see both a softening of employment and inflation, so in other words, growth seems to be slowing down, but prices are going up. So normally, you know, if you think about unemployment, let's say a lot of people are losing their jobs, having a hard time finding jobs. What would you think that would do to the price of goods and services? Well, these are now people without jobs, so they can't buy as much. So demand softens. So you would think prices would moderate, right? But sometimes they don't. Sometimes you can have slower growth of the economy and prices going up. They call it stagflation, right? Those of us that remember the 70s fondly, or at least just remember them. Although it was a great year for the Cincinnati Reds, I will say that. A great decade. You can have that, and that kind of throws everything out. I think it's hard to agree on the right playbook for that kind of environment. I'm not predicting that we're going to have that, but in any event, actually, there's been some articles on municipal bonds that say they're great investments right now. Their default rates are low. There was even an article, and I don't know if I can find it. Let me see if I can find it. That said muni bonds were good options even for folks in lower tax brackets. Let me see if I can find it. It may have been a Wall Street Journal article. Although Bloomberg just came out with an article, muni investors brace for bumpy fall despite expected rate cuts. So I don't know what that's about. I could sign in. I do have a Bloomberg subscription, but I always read it on my iPad. I think this was the Wall Street Journal article I had in mind from a little while ago, a week ago, less 5 days. Tax-exempt munis versus taxable bonds, which has higher returns. I think it was this article that said even for folks in lower tax brackets, they can be a good deal. But I may have that wrong. But there have been a number of good articles on municipal bonds. But I think they're reasonable alternatives. And you only want to own them in a taxable account, right? Because of the tax, you're getting a lower yield, but there's no federal income tax. And depending on where you live and if the municipal bond is issued from your state, you may not have state income tax as well. So I thought there was another article. Anyway, so yeah, I think they're good options. I don't happen to own any at the moment, but that's really neither here nor there. Noreen wants to know what the Manning cast is. So Peyton Manning and Eli Manning, two former NFL quarterbacks, both of whom were Super Bowl winners and considered, they're Hall of Fame. I don't know if they're in the Hall of Fame yet. Are they in the Hall of Fame? Probably not. I don't know how many years have gone by. But in any event, Super Bowl winners, and they have a show that sort of airs at the same time as Monday Night Football. Not every Monday night, but maybe 8 or 9 games a year. And it's like you're just hanging out with them watching the game. And in fact, you know who's on tonight? Bill Murray is one of the guests on the show tonight. So that ought to be fun. I think, is it Randy Moss is on? Who else? There's someone else. Oh, Saquon might be on. Is Saquon Barkley on tonight's Manning cast? So Saquon is, unbelievable. He went to Ohio State. Just kidding. I know he went to Penn State. I just wanted to make the Penn State fans kind of go berserk. They're probably screaming in their living room right now, and their wives are like, and let's face it, it's mainly men. I get it. But maybe it's not. Maybe the wives are screaming. They're like, did he say that he went to Ohio State? He didn't go to Ohio State. I'm still pumped from that Ohio State win over, what's that team in South? Where are they from? Oklahoma? No, that's not right. Maybe Texas? I don't know. I think there was a Manning involved in that. By the way, I am rooting for Archie Manning. I'm a big fan of Peyton and Eli. I just don't root for him when he plays against Ohio State. Let's see. I think it's Saquon. I don't know. It's probably not important to our show, but I just have to know. I think it's Saquon. I can't. Everyone wants to add. I mean, just give me the answer. I need like LLM or something, an AI. Well, Randy Moss, Bill Murray. I think they said Saquon. Anyway, I'll give up. We'll find out. But he's just a phenomenal running back. By the way, did you see the game last night? I watched it today. It was like unbelievable. By the way, Derrick Henry, I mean, phenomenal running back. But the Bills found a way. That was an amazing ending. Okay. So good question here. Will lowering rates not stoke inflation? That's a great question. I mean, you would think so. Now, a quarter point, but I'm more concerned about inflation than I am employment. But again, what do I know? But people are talking about 2, maybe even 3 rate cuts this year. I don't know. I don't know how we don't have issues with inflation, but I guess we'll find out. Okay. Well, let's look at the poll. What did you guys come up with? So most of you bought more bonds, 47%, but 35% have bought more stocks. And it looks like 14 have sold stocks to cash and 3% have sold bonds to cash. Yeah. Okay. I haven't done any of those things yet. I don't know that I plan to, but yeah, I don't think so. But those could be good moves. There's no judgment here. You guys, I may wish I would have done one of those 4 things. I'm just not sure which one of the 4 I should want to do. Okay. Let's see. What do we got next? PWare likes multi-year guaranteed annuities, which was one of the questions that I answered in the video I recorded today that will get published on Friday. So they're kind of like a certificate of deposit, but they're not with a bank, they're with an insurance company. And the other big difference is the penalties for taking the money out early are pretty severe. And so, but their rates can be a bit higher than a comparable CD. So there's a trade-off. And the hard part about it, in my view, is that he mentions a 7-year MYGA, is what I call MYGA, I don't know, multi-year guaranteed annuity, at 6.2%, which today, assuming you're under, I would want to keep it under the guarantees in my state that protect me in case the insurance company goes out of business. But assuming you've done that, by the way, not much different than keeping money at a bank under the FDIC limit, same concept. And for many states, it's the same number, 250,000, but not all states. Some of them have lower numbers. I don't know of any that have a higher number, but there could be. In any event, the 6.2% to me sounds great now. Will it sound great for the next 7 years? You don't know. But in some ways, you're making that same kind of bet when you invest even in a bond fund that has an average duration of 5 or 6 years. You're kind of making that bet, which again, the way I get comfortable with making that bet is diversification. I have some short term, intermediate term. I have some tips, and you sort of mix it up. At least that's what I do. All right. Josh wants to know if I can recommend a simple free spreadsheet for calculating Roth conversions and the tax. Not Boldin or Prelana. I don't know of a spreadsheet. I mean, and I guess what you mean conversions and the tax. I mean, you could probably calculate the tax, I would think, without a spreadsheet. If you know what tax bracket you'll be in, and of course, I suppose depending on how much you convert, it could span multiple brackets. The tricky thing, though, is that brackets are only part of it, right? Because depending on your situation, the conversion, which is going to be treated as ordinary income, could not only, you're going to get taxed on it, but it could also, depending on other factors, take other benefits away. It could take you out of a certain income range that would have qualified you for other deductions. So what I would think you would use is tax software. And the calculators now, I don't know if they're updated yet. They should be, I would think. Certainly before the end of the year, when you have to make this decision, you should be able to use one of the tax tools to get an idea of, the tax consequences of your Roth conversion. I'm just looking up like TurboTax. I don't know if they have it yet. Others in the chat might be able to chime in. Yeah, they're just showing the 2024 calculator. That's probably what I would use. If you have someone that prepares your taxes, get them to answer the question. But I don't know of a spreadsheet. If someone in the chat does, they can mention it, maybe drop a link. I'm not aware of any. So UK wants to know, as you approach retirement, should we make HSA portfolio more conservative too? I don't think so, or at least I'm not, and I can tell you why. Initially, there's some appeal to that. For example, my current thinking is that when we get to Medicare age is when we'll start using the HSA. That's my current thinking. I suppose that could change. And you might say, let's just imagine we're there now. You say, well, wait a minute, Rob, you've told us don't invest in the stock market if you need the money in the next few years, and you need it right now. But money is fungible, right? So I can still keep 100% stocks in an HSA. And if I pull out $10,000 for some expense, health expense, I can then rebalance across all of our portfolio. So let's say, for example, I take out 10,000 of the HSA, and let's say the market's down. I'm selling at the worst time, and I cash out 10 grand. But at the same time, as part of rebalancing, I go into my traditional account, take 10,000 in cash or bonds, and do it the same day and put it back into stocks. You see, I've bought and sold stocks the same day, same amount. So the net effect of that is I'm not really a seller of stocks. I'm net neutral, right? But it's allowed me to take money out of the HSA, which is the account I need to take it out of, right? But for tax reasons. But then I can just, again, rebalance, and I could, depending on the circumstances, maybe I do it in a taxable account, but probably not. And so the reason I would keep HSAs 100% stocks is because, again, longer term, I want it to grow as much as possible. So I think that's how I would do it. I don't think I would get more. My overall portfolio might get more conservative depending on where I am in my retirement journey and whatnot. But I don't think that would require me to specifically make an HSA more conservative. At least that's my current thinking. Yeah, ask me tomorrow. I might have a different answer. Yeah. So when I talk about bond market collapsing, if you maybe that's a bit extreme, but I get it happens. But you think about bond prices when they go up, right? So you think about stock prices, they go up, right? And normally the market cheers that. Well, bond prices go up. What happens to yields, right? They move inversely to price. By the way, stocks are the same way. What moves inversely to the price of a stock? the dividend yield, right? If prices jump up, assuming the dividend hasn't changed, just like we'll assume the interest rates haven't changed, and they haven't, right, on existing bonds, assuming, most bonds, they wouldn't change. But the prices go up, the yields go down, right? It's true with dividend yield for stocks. It's true for bond yields. And but if prices go down, right, that would be sort of a bond route. Yields shoot up. Again, if that happens and you're just now buying bonds, and all of a sudden the yield on the bond you want jumps from 5% to 7%, you're thrilled, right? Because you're buying. But if you're an owner of that bond, it's like, hey, yikes, that's not good, right? And so that's kind of what I mean, or at least, how I think about it. A lot of good conversation. I'm just going to pass over about tariffs and whatnot. Besides tariffs, what would be some of the catalysts that might stoke inflation? What should we be watching for inflation volatility? Well, in theory, and I think back to the 70s and the oil issue, but the price of oil affects so much, right? But now, right now, oil prices. I was listening to a show, or maybe it was CNBC, but oil prices. There's some concern, like with Russia. There's always a concern with Russia about something, and that can affect oil prices. I think OPEC is going to increase output, but maybe not as much as they had originally said. And so I don't know what oil did today. Let's see. Yeah, it was up marginally. So, but oil can be a wild card. Obviously, you mentioned tariffs, and we haven't seen a spike in inflation like some have predicted, but many say it's coming. I don't know. Maybe it is. I guess we'll find out. Obviously, if demand picks up, but at least with the current employment situation, which still is, I think, reasonably good, that I just don't see that happening. But again, we'll get CPI numbers later this week. Of course, they're backward looking, right? So we'll see. But I mean, those are a few things that come to mind. Again, I'm not an economist. I did take macro and microeconomics in college, and I got A's in both classes. But it still doesn't qualify me for anything. But I enjoyed the classes. Oops, this is the one I want. Kat wants to know if I anticipate making any changes to your asset allocation. Marginally, as I invest new money, I am focused on small cap, international, and value. But you're talking, it's such small dollars. It's not going to. First of all, it's not going to change my stock bond allocation. I don't really have, I have in the past, but I don't have a set allocation for international or small cap, which might strike you as odd, because I would probably recommend that most people have that. So why don't I? Two reasons. One, in my taxable account, I've got total US, I've got total international, and a small cap, those three funds. They're all Vanguard funds. And I'm not going to sell them because of embedded, unrealized gains. So they're sort of locked in place. And then on the retirement account side, most of our money is in a Vanguard target date retirement fund for simplicity. And so I'm kind of locked into a certain asset allocation that I can't, if I'm gonna make serious changes to it, I either need to get out of the target date retirement fund, which I don't want to do, or I've got to sell some of these taxable account funds, which I don't want to do. And so but I've looked at the overall allocation and I'm fine with it. And then I kind of just leave it alone. I can affect my allocation through new investments, which could include reinvesting dividends. But you're talking relatively small numbers, and it's just not going to move the needle much. that could make my portfolio a little different, but nothing to write home about. Yeah, I don't plan any changes. No. I often think about investing in gold, but I just never do. That was one of the questions too for Friday. How to invest in physical gold as opposed to like a gold ETF. I just can't bring myself to do it. Well, Eric says, I've been waiting for a good time to get a position in BND, which is a Vanguard Total U.S. Bond Fund. Does the Fed lowering rates help or hurt things like BND? Well, I don't know when a good time is, by the way. I just, for kind of all the reasons we talked about. In theory, in theory, I would think the Fed lowering the rate wouldn't hurt. What impact it's going to have on the yield for BND, though, I don't know. The BND it's got a duration of about, I don't know, 6 years. Let's look it up. Here it is. I'll show you. Yep, 583 is the effective duration. So, a quarter point reduction in the Fed rate, maybe it has a marginal impact. I wouldn't think it would be significant. So, but this is what I mean. Like if I wanted to invest in BND, I would just invest today. I just, trying to predict and all that. I've just never had much luck with it. Braxo wants to know if you can get a look at my portfolio. Yeah, I'll do a video on it. I mean, I've done some in the past. Just go to the last one. I have moved down closer to the 70% mark in stocks, just as, but some of that is as much because some of that money I need to spend. So once I spend it, maybe it bounces the stocks up a little bit. I could just exclude it from my allocation, but it hasn't changed much. But I will do an update video. I may be watching too much YouTube and questioning everything I do. Maybe I'll do, not Monday night, but maybe I'll do my portfolio update live. So then people can ask me questions. I don't know. I don't know if it's a good idea or not. All right. I'm going to end the poll. Should I do my portfolio update live? Yes, no, I don't care. That's fair. Okay. So I don't follow this question exactly, and the ticker has got too many letters in it. But I'm guessing it's this one. If we just take out the Z, it's the Vanguard tax-exempt bond index admiral shares. It's a mutual fund and tax exempt. So if we look at the portfolio, it might be easier to look at it on Vanguard's website. It's an intermediate term. It's got a duration of 7. And if you look at what it owns, you'll notice, yeah, so this is a muni bond fund. And you can see that, Maryland State, California, University of California, New York Metropolitan Transit Authority, Illinois. And I think this is a great fund. It's again, the higher your tax bracket, the more you'll benefit from the tax benefits of this fund. I would not own it in a retirement account. I wonder what the yield is. 3.28. Again, it's lower than, say, a comparable duration fund outside of the muni bond field because of the tax benefits. So, but yeah, it's very inexpensive, 7 basis points. I think they probably have an ETF version of this as well, but I'm sure they do. I just don't know the ticker off the top of my head. Oh, I see. Yeah. So they are investing in a brokerage. So that's good, because you wouldn't consider a municipal bond fund in a retirement account. So Brax, this question comes up on you. I think this is a YouTube thing. You can, in my view, SCHD is not an alternative to BND, not even close. It's a perfectly good fund. I actually own both of those funds. But the problem is, so the thinking behind it, I assume, is that SCHD pays dividends, and those dividends seem safe and secure. And so even if prices go down, you'll get those dividends. Not always true, by the way, but okay. But when you look at the volatility, and I'll show it to you. Here's the fund, SCHD, and we can probably get volatility in a couple different places, but so the standard deviation is 15. That's a measure of risk, one way to think of risk, measure of volatility. And if we compared that to like an S&P 500 fund, so remember this is 15, right? Let's compare that to the S&P 500, which will be higher, I assume. Oh, it's not. It's lower. Huh. So there you go. That kind of answers the question. Now, what we could do, let's get a little more, one thing about volatility. I'll bring this up. I just want to get to the right page. Notice here, we can select 3, 5, or 10 years. So it does matter what period of time. Let's go to 10 years. It pops up to 1534. If we go to the Schwab fund and go to 10 years, it's still pretty close, 1495. So there's just not a big difference. And if we compare that to BND, BND is going to be well under 10. Here it's 6.9. That includes 2022. Yeah. If we add to 10, it should go down, to 5. And the reason it goes down, I think, is because at 10 years, the volatility we saw in 2022 doesn't have as big an impact because you're looking at a 10-year period as opposed to 3. But in any event, yeah, I just don't think they're comparable. They're both good funds for different purposes, but I just don't see SCHD as an alternative to a bond fund. I got to show you the coolest YouTube channel. Well, I haven't watched a full video from it, but I looked this up. Let me pull it up here. So it's RAMY, RAMYRC, radio controlled, and it's flying planes with Tyler Perry. So apparently Tyler Perry is a huge radio controlled planes, fanatic. And so this guy films YouTube videos flying these planes from I guess it's Tyler Perry's home, which is just ridiculous. So I'll just stop it. But I think this is the guy behind it. I don't know who this guy is. Like I said, I've not watched a complete video, but I think this is Tyler Perry's. Well, that's not his house. It's crazy. I think that's where he keeps these massive radio controlled planes. It's just ridiculous. This guy's got, this one is, I think this might be this guy, this particular channel with 4.5 million subscribers. But basically, if you Google flying planes with Tyler Perry, I don't know, it's just fun. All right. So you have no idea what you're going to learn on this show. All right, where am I? Let me look at this. I got to look at this question because it's in all caps. James is hollering at me. On your recent Empower demo, I used it, but I have some cash for house repairs, and Empower factors that in and says I have too much cash. How should I handle cash like this with Empower? So in Cubera, you can set any investment as non-investable, and it will pull it out of your asset allocation. I don't know how to do that in Empower exactly. If your cash is in an account by itself, let's say it's in a high yield savings account, I think you can. I got to log into my demo account here for Empower. Oh, it's going to want to. It's going to want to text me. Why do you want to text me? Let's see if I can get it on my watch because I don't have my phone down here. Well, there it is. Let's see if I can pull it up. Nice. All right. Hang on for a second. Well, I can't. I'm not going to be able to log in. It's a long story, which really annoys me. But what you can do, I'll just describe it to you. And I showed this in the video where there's a drop down and you can select which accounts it's factoring in whatever screen you're on. So you could just uncheck your cash account and it'll show you your asset allocation without that account. Hopefully that helps. Now, if it's part of a larger account, I don't think you can separate it out at the investment level. So with Kubera, you can. All right. So this is a good point that Noreen makes. If people have given up on finding a job, right? Because the unemployment rate is, the percentage of people that are looking for a job that don't have one. But then you also get the participation rate, and I don't know where that stands. I think in the last numbers it ticked lower, maybe, but not dramatically so. Ted is not wrong. So growing up in Ohio, baseball coaches hated the Cincinnati Reds because I think I've mentioned this before, but we wanted to slide headfirst into every base. We crouched real low and we did this with our arm when we were trying to bat. And some of you know what I'm talking about. They just shake their head. They gave up. What can they do? All right. I can specifically remember coaches talking to us. Do not slide head first, ever. This is Little League. Okay. Baseball was not my game. I was not particularly good at baseball. Gene wants to know, if I were going to take cash and invest in bonds, would I prefer inflation protection or traditional bonds? So my approach to this normally is basically a 50-50 split. I don't know which one's going to end up being better. It'll just depend on the market's expectation of inflation now versus what it actually is, over the period of time that I hold these bonds. My actual allocation is actually more in traditional bonds than TIPS. Why? Again, that target date retirement fund. And it was just I had to make a choice, simplicity or my preferred exact allocation. And I was willing to, I just wanted simplicity. So I don't know exactly what my allocation is. Maybe 75-25 in terms of traditional versus TIPS. Something like that. I just saw it and I lost the question, but they were asking me about, oh, here we go. The 3 footballs, Ohio State. So let's see here. Whoops. Oh, no. This is, well, that's Zeke Elliott right there. It's hard to believe, like, is he playing? I don't even know now. And Posey was receiver, as I recall. So that's this one. Oh, this is Zeke Elliott. Yeah. Oh, this is Zeke Elliott right here. I don't know who that other one is. I can't read it now. I have to go back and look at the number. Cardale Jones, 12 gauge. Oh. Anyway, I don't know what this third one is. So I'm embarrassed to say I don't know who that signature is. I don't know. Maybe someone can let me know who that is. I have no idea. So sometimes the jersey number, which they'll put on, like here, helps. Anyway. All right. You know what I could do? I don't have my phone, but I could take a picture of that and ask ChatGPT. So Just B wants to know if we should trust any of the numbers coming out of this administration. Absolutely. We're talking about BLS numbers. I mean, at least from everything I've read, there are so many people involved in these numbers that it's not like the president can install someone new at the head of the BLS and then just completely manipulate the numbers, at least not with everybody knowing. Now, what some have said is with spending cuts, maybe they can't get as much survey data, and but even if that's true, I'm not sure which way that would cut. Would that hurt would that make unemployment numbers, or CPI numbers? Would it affect them on the upside or the downside? I don't know. I think it's a very important question. So don't misunderstand me. It's a very important question, and I don't like the administration. Here's the thing: like when I practiced law, you had all these ethical rules that you had to follow, but you also had to avoid not just an ethical conflict, for example, conflict of interest. This is an example. You had to avoid even the appearance of, say, a conflict of interest. And I think that applies in this case too. And I think messing with the Fed, I think it's poor policy. It's poor decision. I know I've already strayed in a little bit into politics, but whatever. Okay. What's next? Han wants a fifth option, do nothing. Do nothing is usually my go-to choice. So 68% want me to do that live, 24% don't care. 7 have said no. I'm curious why the no. Like, I don't know. Anyway, all right. Perry has an interesting question. What if it's Tyler Perry? Probably not. If you inherit a portfolio that you didn't get a step up in value, I assume basis, trying to figure out why that would be. In any event, how would you go about tax loss harvest? For example, sell the ones that have more gains or wait for them to go down? Well, I don't know that waiting for them to go down would be the right answer, right? Unless your taxes are more than 100% of the difference, right? Unless I'm missing something. I mean, I'd rather, if I have something that's got a basis of 50,000, I'd rather sell it for 100 and pay taxes on 50 grand than sell it for 75 and pay taxes on 25, because I'm going to be ahead, right? So I don't know that I would sit by and wait for it to go down. I don't think so, unless I'm missing something, which is very possible. So Bradley wants to know, should we buy gold instead of being in a high yield savings account if there are rate cuts and inflation? No, I don't think so, for a couple of reasons. I mean, I think owning some gold is a reasonable choice, even though I don't own any. There's a lot of things I don't do that I still think would be reasonable. And maybe there are some things I do that are not reasonable. But to me, high yield savings account is for money you need to count on. And it's earning interest. And the interest right now is above inflation, at least if you've got a high yield savings account. So I'm okay there, right? And presumably it serves a purpose. Either it's an emergency fund, it's something you're going to need, maybe in the next 3-6 months, maybe next year. And so in that sense, I don't think gold is a good substitute for that kind of asset. The second concern I have is I'm not convinced that gold is a great hedge against inflation. Sometimes it is, sometimes it's not. Some would argue that it's a better hedge against a financial system crisis of some kind. And there was an article, I think I included it in the newsletter a couple of months ago. I want to say it was from a Wealth of Common Sense blog, but I could be wrong. Gold as hedge against financial crisis. I'm going to put in Wealth of Common Sense. I could be wrong about that part of it, but let's see. Yeah, he's got one from 24, but that's definitely not it. What's this chart on gold? I'm looking at this one. I did include this one, but I didn't think this was. Here's gold. Yeah, this is not the article. This was an interesting article, but that wasn't it. So in any event, let me get rid of Wealth of Common Sense in my search. Yeah, I can't find it. Oh, it could be this one. I do link to the conversation every now and again. Let me this might be the article. You can just search for it yourself. Why gold may be losing its shine as a safe haven investment. But I just don't have confidence that gold is a real hedge against inflation. That's not why I would own it. And what some would say is, well, wait a minute, Rob. Over a long period of time, it basically goes up by the rate of inflation, and that's true. But in the short term, it can be a really poor hedge against inflation. And if it's the long term I'm focused on, why wouldn't I use stocks? Because they clobber inflation over the long term. Gold just keeps up. But if I'm thinking long term, I'm not sure why I would be in gold. A lot of folks will say, well, since 2000, it's beat the S&P 500. Yes, but you're cherry picking the dates. Long term, gold has just not been a great investment, at least compared to stocks. All right. This will be fun when Archie Manning is playing a Monday Night Football game. I wonder if Peyton and Eli will still be doing Manning cast. Of course, it could be not that long from now, a couple of years maybe. I think he played pretty well this past weekend. Didn't he have 4 touchdowns, maybe 1 interception, something like that? Of course, he wasn't playing, a top tier team, as I recall, but still. When I'm evaluating ETFs for brokerage account, do you look at the tax efficiency rate? Well, I absolutely look at the tax efficiency of the fund. I don't look at anything specific to tax efficiency rate. For starters, for me, it's easy. I have low-cost index funds from Vanguard that are incredibly tax efficient. But I can show you what I would look at. I would just look at the actual distributions. The easiest way, I think, is Morningstar. So if I were going to look at, we'll just pick, it doesn't matter. We'll just do total market. I would come down to, let's see. It would be performance, right? Is it performance? Yeah. Go to performance and then go to distributions. And I'm looking for a couple of things. So this is a stock fund. So the income is going to be dividends, and that's going to be whatever the total U.S. stock market dividend rate is. There's nothing I can do about that. But I'm going to look at it. It's under 2%. We can look at it in a second. But then I'm going to look to see if there's any blue. I don't want blue in this chart because that's short-term and long-term capital gains. And those are capital gains that you would get hit with if they showed up in this chart, even if you didn't sell any shares. That's the thing to keep in mind. ARK, AR, is it ARKK? Yes. Performance, distribution. Look at all that blue. I don't want that. That's short-term. Look at that. That's a truckload of short-term capital gains plus long-term in the dark blue that you're getting hit with each year, even if you've held on to all your shares. Yeah, I don't want that. And then I would look at the yield. But again, I'm using index funds. I mean, the yield's just not much. This has probably got almost no yield. Let's see. This is ARK. Yeah, yield of 0. But that's just because of the kind of investments that it invests in. But stock market's what, 1.2 maybe? I don't know. SEC 114, trailing 12, 117. So, I mean, an incredibly tax efficient fund. Love it. Perfect for a brokerage account, in my humble opinion. What was the one show? Was it A Good Wife, where the judge would always interrupt? Yeah, the lawyer would be making an argument. The judge would interrupt. The lawyer would say something like, I believe, blah, 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 blah. And the lawyer would interrupt and say, in your opinion. Yes, judge, in my opinion. Okay. So this question, how would I invest a lump sum given stock market? Well, the U.S. stock market, and specifically U.S. large cap growth, is what's bumping at all-time highs. I would invest it right now, and it would be a well-diversified portfolio that would include small cap, value, international. It would include the expensive large cap growth. I'm going to have a total U.S. stock market fund in there, but it's going to be a well-diversified portfolio. I'm sure U.S. markets will go down. Well, we know they will. We just don't know when. And I just, assuming I'm a long-term investor, that's just what I would do. And that's what I've done in the past. I don't have a lump sum to invest right now. If I did, that would be great. So Bryce wants to know my ideal Manningcast ideal guest host, but that's just it. I don't want any guest host. I mean, I like their guests. Maybe that's what we're talking about. Okay. Well, tonight's perfect. Bill Murray, love it. That's great. Funny. They get football players on there like they're going to have tonight, or former players, and that just depends on the player. Some are good and some are just like, eh. But I tend to like the guests. I probably prefer the non-football player guests over the football players. Depends who it is. Some are just kind of fun, but yeah, Bill Murray is, perfect. John wants to know, can I define burn rate? Is that what you spend or spend pensions? Well, when I talk about the burn rate in retirement, what I simply mean is how much of your savings are you spending each year? What percentage? That's what I mean. And then interest income has a great role to lower burn rate. Well, I don't separate out interest and dividends here. Let's imagine, I know that people get, particularly in retirement, they get really focused on dividends and interest, and I get it. And certainly if you've got, particularly in a taxable account, investments that are paying dividends and interest, you're going to get taxed on them. You're going to pull that out and spend it because why not? You're already getting taxed on it. But at the end of the day, your retirement savings is a certain amount. Now, some of that sitting in your account could be from dividends and interest. Maybe they got paid to a cash account inside your brokerage account. Maybe you reinvested them and it's all shares. But just imagine it's a black box. You got $1 million in there, but you don't know what the dividend yield is, the interest rate. You don't know what's sitting in a cash account or not. You don't know how much shares you have. You just know you got $1 million in value and you need to spend 40 grand this year. Let's put aside taxes. Does it matter? I mean, what if you've reinvested it all, but you don't even know that? It's in this black box, and so shares have to be sold. Does that matter? Why would it matter? No matter whether it's shares get sold from dividends, you're taking 40,000 out. You're going to have $960,000 left, if my math is correct. I think it is. That's what you're going to have in your black box left over. Some of it could be in a cash account. Some of it could have been paid as dividends, as interest, as shares. It doesn't matter. At least that's my view. I'm getting kind of fired up over dividends and interest. I need to get a life. Well, this is funny. Referring to gold, it can be kind of addicting. If you haven't started investing in gold, don't do it. So the only gold I've ever owned, I owned a 1 ounce bar of gold, and I won it at a conference by putting my business card in. 1 ounce of gold. Now, it wasn't trading at $3,600 or whatever the spot price of gold is these days. Kind of like holding on to the football during the live show. And I sold it. I don't even remember what it was worth. And then, like the same year at another conference, I won, my wife and I, for two, a free trip to London. That was a good year. Should have played the lottery. Hey, by the way, did any of you, oh, here's a question. Hang on. I got to put the football down. I'm going to end this poll. 68% says I should do the live update. Now, be honest here. Did you play Powerball? I'm going to say yes, no, and yes, and I won the big prize! Exclamation point. All right. I didn't play, by the way. Not that I haven't in the past. Every now and again, when it's that big, I've bought a ticket. But, you know, I'm one of those people that goes in. I'm like, excuse me, how much does it cost to play? Is it per ticket? How does it work? Can the computer? You know, there's a long line behind me, and they're all like, "Oh my, not one of those guys." So what do I think of Raisin these days? I actually put them in the newsletter because they had a $1,000 bonus thing going on. Their rates are good. I mean, I don't invest in Raisin. I have my money in money market funds, and I would, from time to time, maybe T-bills. But there are a lot of folks that don't want that. They want a bank or a credit union. I think the rates are pretty good. And they've got a bonus going on, I think, to the end of the month. So they are an affiliate, but I shut down all cards. I don't really promote banks. I put them in the newsletter because of that $1,000 bonus, and I thought the rates were pretty good. But I don't really do anything with them. But again, not for any particular reason. I just, you know, I guess after shutting all cards down, not tracking all the rates, it kind of ran its course. All right. So this question, what about iBonds instead of tips? So, I mean, iBonds are a good investment, but, you know, you have to buy them directly from the government. Treasury Direct's kind of a hassle, but you know, I've done it and it's fine. And you're limited to how much you can invest. So in terms of like longer term asset allocation, tips are just easier. A lot of folks like iBonds because they're not publicly traded, right? So their prices don't fluctuate. You're always buying and selling directly with the federal government. So I think that gives some folks some comfort. It doesn't really give me any comfort. And it was a complexity that I just sort of got tired of dealing with. But I think they're great options. I don't know what their rate's going to be. Has it been set? I'll tell you, if you're into iBonds, the website you want to follow is called Tips Watch, and I link to his content from time to time in the newsletter. He knows more about iBonds and tips. You know, again, Tips Watch, but he covers iBonds. When rates decline, iBonds get more attractive. He just published this yesterday. I might include this in this Sunday's newsletter. I don't know, but he's sort of the site that I would follow. I don't know him personally, but a great site, very, very knowledgeable. Yeah. Okay. Did I publish, from Steve, did I publish a video on Kitces Bond Tent and sequence of returns risk? Not recently. I might have done one on a rising equity glide path. Let me see here. I just don't remember. So I Googled this and one of my videos comes up. Hang on. Here it is. That's when my desk was faced the other way. By the way, there's the extent of my metals collection. And the sum total value of all of that's about $80. These are proof sets from like the 70s or something. This was sequence of returns risk. I don't even remember what I said about it, but here's a link to Kitces rising equity glide path, risk-based guardrails. So you can check that video out. I think, I think a rising equity glide path or, bond tent is another way to look at it, I guess. I think they can be reasonable approaches. None of these things solve the sequence of returns risk issue. Whether you're going to be happy with the outcome depends on, what the markets do over that, we'll call it 10-year period. And I kind of think that, so the guys behind this, Michael Kitces and Dr. Wade Pfau, Pfau, who's written some good books on retirement. They both have written, excellent content. I've had, Kitces has been on the show, so you can look that up in the channel. I don't know if we talked about bond tents specifically. And I interviewed Wade Pfau. That might have been on the podcast way back in the day. I can't remember. But whether it's going to work out in the end, I don't think it's a bad strategy in the sense that it's going to, do harm for the most part. But it's really going to depend on what the markets do over that time when you've got, let's say, 60% in bonds or whatever it is. But you do have to remember with these approaches, you have a lot of questions to answer. What's your bond allocation going to be and when, and how are you going to change it over time? So there's some work to be done to try to figure that out. And for me, I'm not so sure it's worth all of that headache and complexity. When I say for me, I mean for our personal situation. But I guess to answer your question, I don't think I've specifically published a video on Kitces and bond tents. I can. Let me see if I can spell it right. I'm just making sure. I don't think I have. Yeah. But I can add it to the list. So, and it's, so you can think of, you increase your bonds as you're getting close to retirement, and then you spin them down. So that's the tent. And as you're spinning them down, it's a rising equity glide path because you're spinning your bonds, your equity allocation presumably is going up unless the market's really crazy. Okay. Robert said he had some dealings with Pete Rose in the 80s and 90s. We had a neighbor who was a prosecutor involved with Pete Rose. So he had some dealings with him too. And my former boss, I think, was he part of the defense? He was somehow involved. I can't remember how. The only politics I ever got involved in, we defended former Congressman Dan Rostenkowski. I may have mentioned that. I mean, I was a young associate. I was on the team with, a dozen other lawyers. But I got to meet him and interview him. Good storyteller. So, question of we get this question every now and again about Wellington, and Wellesley's the other one. These are actively managed, but low cost funds at Vanguard. I mean, their history has been nothing short of phenomenal. So, based on history, assuming that the allocation is correct for you, they've been great funds. I can't say what the future will hold, but historically they've been phenomenal. Braxa wants to know if ChatGPT can actually figure out a signature by a photo. I don't have my phone with me, but I don't know. I mean, of course, it would know that it's an Ohio State football player. So maybe, yeah. I think there's a reasonable chance. T. First name is T, but I don't know. I should know. I'm embarrassed that I don't know. All right. What time is it? Oh, we're down to the last 10 minutes. Boldin 52. I have a University of Michigan ball that I can send you. Go Blue. I'll take it. I'm not sure how you're going to get it to me. I mean, it wouldn't be in the camera shot unless maybe if I got a sword and put through it. Is that too dramatic? I don't know. I'll have to think about it. Maybe, no, I wouldn't do that. It would be a Ohio State flag, and the pole would be kind of like what one team did to the middle of our field one year. Although, frankly, we deserved it. So there's that. I think that might have been last year. Did you guys run that on replay during the national championship last year? Okay, I'm being petty. It's not pretty. Not a good look. All right. Most of you are like, what show is this? What is Rob talking about? What's happening? Let's see here. 29% of you played the Powerball. 2% of you won. See, the big prize. I don't think that's true because I only think two people. One from Texas, right? The other from Missouri, I think. I don't know. I read it. What I read was it was a gas station in a small town in Texas, and they weren't sure where the winning ticket was sold in Missouri. That's what I read. Okay. Joe wants to know if I've ever done a video on when to take Social Security. I have. Well, I've talked about it a couple of times. By the way, it's been so long and I've done so many videos that sometimes I forget what I've done. But the video that you might want to check out is an interview I did of Mike Piper. He is, I'll show you the video, but before I do, he created this tool, which you may be familiar with. It's called Open Social Security. It's a free tool, and I think one of the better ones for trying to figure out. None of these tools will tell you when you should take Social Security because there's too many assumptions that need to be made. The one thing I'll say about this tool is that this little checkbox looks so innocent right there, but it's actually really important, and it does that. And it opens up a lot of options. And if you click any or some of these options, you can't see it, but it opens up more options down here. So that's the tool he created. And the interview, you just go into YouTube and search Rob Berger interview of Mike Piper. But here it is. It's loading. There we go. There's Mike. And there's me with making a funny face because I stopped it. There we go. I'm thrilled. Okay. Anyway, that was over an hour, and we talked about a lot of issues, but Social Security was a big one. So I might suggest you check out that video and his tool. Looking for a good book on do-it-yourself distribution strategies for already retired couple. Not a big Wade Pfau fan. Any suggestions? Well, yeah, the book I'm thinking of is Don't Go Anywhere. I'll be right back. I'm not really sure that I want to recommend this book, but I'll show it to you. It's called Living Off Your Money. And the reason I hesitate is because it's a very technical, dense book. But if you wanted to read something that showed you a lot of different ways to different withdrawal strategies, this book will do it. It comes up with its own strategy, which I'm not really, I'm not sure that I would endorse. That's one option. Another option is not a book, but is the Safe Withdrawal Rates series over at Early Retirement Now. And Karsten, who's the fellow behind this site, was a guest on the show, so you could look up my interview with him. But he's written a series that's, I don't know how long it is now. 60, there's part 50. Again, he has his own perspective, so you have to keep that in mind. But this is a great resource, and you could spend hours reading through all of his content on safe withdrawal rates. The other thing I'll mention, this app we've looked at in the past, FI Calc, we normally use what's called constant dollar, which is what Bill Bingen used in his 4% paper. But they actually have a lot of different strategies. And, you know, if you pick one and you click this, learn about this strategy, it'll give you some background on it. You could do more research. So, but this might be a tool to think about if you're just sort of beginning your, you know, your journey into withdrawal strategies and distributions and retirement. But between those, yeah, I might start with Big Earn or Early Retirement Now, that series. This book, I enjoyed it, but it's pretty technical and yeah. If you're an engineer, you'd like this book. All right. Okay. Legit penalty flag at the end of the 2002 Fiesta Bowl. I remember that. I think I was in Miami watching that game. We won, right? The last time I was at the shoe, Woody Hayes was the coach. So it's been a long time since I've actually gone to a game at the shoe. Now, I've been to games at Maryland since then, which is sad. I need to get back to the Buckeye Stadium, the Horseshoe. Okay. How are we doing on time? I've got 2 minutes. All right. Do we have any? Did I end the poll? Oh, that was just who won the lottery. 2% of you won. That's pretty good. It's like over 6 of you, 6.1 of you. I think you were just clicking that answer for fun. Do you think, here's a legit question. All right, we'll end the show with this legit question. If you had won, would it make your life better or worse? Better, worse. I'm not sure. Well, you know, I'm not sure the answer is better, at least for me. I don't know. I'm going to skip all the way down to the bottom of the chat. By the way, big thanks to Noreen, who always is wonderful and helpful, and Matt, who's always wonderful and helpful. You probably see Noreen more in the chat. Maybe, I don't know. But yeah, you got to watch out for Matt. He'll surprise you when you least expect it. I don't think I've seen him in the chat, though, tonight, but I know he's there. These two keep the show going. So should you hold these funds in a brokerage account? Well, again, the problem is the bond portion of these funds. So I wouldn't personally, because of the tax consequences, if I could avoid it. Let's see here. I guess that's it for tonight. It's 8:30. So 77% of you think it would be better. Okay. I don't know. Could cause a lot of grief. I'm not convinced. I'll end with this question. Have I used the paid for advice with Boldin? I'm actually having dinner or maybe lunch with the folks from Boldin this week and at a conference. I've never used their paid service, no. It's interesting let me talk about that topic and then we'll call it a night. I've had a number of advisors reach out to me and want to promote their service to do for like a flat fee, say $300 or something. They would do a review of folks' retirement plans. Well, it could be in Boldin or not, but and I'm not going to. I've just decided against doing that from a money-making perspective. Where like they might pay me $50 for each person that signs up, because I just made a decision a while ago that I wasn't going to earn money based on financial advice or a specific investment. I don't want to put myself in that position. I don't like it. 99% of the money my business makes is from apps, and it's basically budget apps and retirement planning apps. And I've talked about that periodically. But then the question in my mind becomes, how can I create like a database maybe of advisors and firms that will do this? Now I have a page on robberger.com of low-cost advisors. The idea behind that was primarily folks that would manage investments, but not charge, a ridiculous 1% AUM and that sort of thing. The problem with coming up with that kind of database is it would require a ton of time to vet all of these people. And what a lot of firms do, they'll use that as sort of a way to, and by the way, I think this is perfectly fine, but they use it as a way to sort of promote their other services, which could include investment management for that 1% fee or even more. And that just, I wouldn't do that. But there are firms out there that for a really low flat fee will do an evaluation of your retirement plan. I just haven't figured out, beyond the ones that are on that one page, I haven't figured out how to, I'm not going to get into a financial relationship with them, but just for, just to get that information to you, I haven't figured out a way to be able to do that where I would be comfortable in making that recommendation. Again, even though I'm not making any money from it, because I would still feel, I'd want to make sure that everything they do is in line with, at least with what I believe, recognizing that how I approach investing is not the only way to approach it, but, it is my show. So there's that. And I just haven't been able to come up with a way to do it. I don't know yet. So, but in terms of Boldin, I've not used it. So I can't comment on it. I think from the folks that I've heard from that have used it, I think it's been positive. I don't know of any, I can't recall any negative reactions to it, but I don't have any personal experience with it. So there you go. All right. Well, 76% think it would make your life better, and maybe it would. Maybe I'm being too pessimistic. I don't know. But in any event, let's see here. I should be back in 2 weeks, which is the 22nd. I don't know. You want to subscribe to the newsletter. The link is below the video. That's where I'll tell you when the next live stream will be. If it's not the 22nd, it'll be the 29th. I may be gone the 22nd, so I need to figure that out. I do want to start doing some live shows during the week, during the day, like my portfolio review. But the other thing I really want to do is have a live shows where I answer questions about apps. And I'm thinking it could be like, I've had people say, can you do a review of Cubera or walk through Monarch Money? And then of course, plenty of people want to look at Prelana or Boldin. And so I'm thinking about live shows where it's just like, you know, we could have some shows that are focused on a single app, but maybe we have shows which is like, you know, ask away. What apps do you want to talk about? The other thing I want to look at is getting people from the company that's behind the app who are experts in it to come on the show with me so that, you know, maybe I can contribute, but, you know, they're the real experts, so they can answer your questions. So that's something else I have in mind. And so we'll see how that all goes. But yeah, that's sort of what I'm thinking. And again, follow the newsletter and that'll tell you when the next live show is. But I'm looking at my calendar, either the 22nd or the 29th, and I will let you know. Okay. I'm going to see the Manning cast. So have a great night. And remember, until next time, the best thing money can buy is financial freedom. Because then, you know, you can go watch the Manning cast and not worry about, you know, everything else. I'm gone. Have a good one.